events to celebrate you all, our amazing, wonderful grad students who contribute so much to the University of Maryland. So please give yourselves a hand. So some of you may have been to some of our workshops sponsored by Graduate Student Legal Aid. We took it up a notch today, right? We usually don't do a spread like this, but again, this is to celebrate you all and treat you for your contributions. So I hope you enjoy lunch today. It's most of it is from Moby Dick, which is downstairs. So I'm a fan, and I hope you are too. Does everyone like this? Should we do this again? Yeah. Moby Dick? Yeah? Okay. Terrific. Well, enjoy your lunch. All right, so we also have a workshop on a topic that is important to a lot of people. You might not be ready to think about buying a home, but it's never too early to start planning, right? Because you don't just one day wake up and say, I'm going to go buy a house. You know, there's some things that have to happen. So we've recruited a couple of speakers who have been in the industry for many, many years. And I'm happy to say they are both graduates of the University of Maryland. and they are active alumni. So we are so lucky to have them with us today to talk about preparing for home ownership, a really big step. So I'm going to introduce them now. First up, we have Orrin Luke. Orrin is a realtor with Fairfax Realty. He has presented this workshop before, so you might think that he is a familiar face. The same goes with Donna Hubbard. And Donna is with, thank you, Fitzgerald Group, right? Okay. And they both presented this workshop. They are a terrific resource. They are making it easy for you to ask questions, because you might not have a question to ask right now today, but you may have one like at midnight tonight. So one of the things they did was provide a QR code. This is a direct line to them, so you can get in touch with them and ask them questions as they arise. So they have lots of goodies on the back table for you and lots of great information to share with you. So please help me welcome Orrin and Donna.
Thank you. Thank you, Debbie. Hopefully everybody can hear me. Thank you for having me here, everybody. Wanted to give you guys another round of applause. You guys have done a great job. I mean, getting to this level, grad students, I mean, this is what we look at as giving back. I feel like giving back, coming from Maryland, graduating here a little while earlier than you, but it just feels good to come back. Me and Donna have been in business. We both bring over 20 years experience in the real estate business, so we're really here to give you a concise, somewhat shortened presentation to try to help you deal with what's going on with the real estate market and also for home ownership. Before I click this slide, that QR code, if you want to use that QR code to ask us questions or follow up later, it will ask you for information. We're only going to email you, so it's something that you can follow up with you with. It does have a block in there if you have a specific question, because I don't think we're going to get to all the questions today, and that's fine, but we'll be able to follow up with you and move forward with you. You also should have there's also actually one is on each table, so you can always use that as well. So I want to get into what we're going to talk about today. And first, I wanted to let you know that I've been licensed in DC and Maryland for over 20 years. Donna's been licensed as a mortgage loan officer for over 20 years. We both bring extensive knowledge, also have gone through different cycles. So that's one thing we want to make certain that you're aware of so we can move forward. And let me see this clicker. Let's do this then. Clicker is not really operating. Let's see if we get Debbie over here. Hey, Debbie, the clicker. Well, I'm going to go and start until we get the clicker going, so that way we can catch up and not lose much time.
So they tested it, but yeah,
That's not working either. It's not working either.
and this isn't working. Woo!
Okay.
Okay, we're gonna
Okay.
hold on. I'm so sorry.
We're going backwards.
All right,
Okay. Now it's working. Okay.
it got stuck.
Okay.
Okay.
All right. So we're going to be going over these topics today. Just an overview of different things. So we're going to go over renting versus owning. We're going to go over are you ready to buy, why you need a real estate agent, choosing the right home, steps of the home buying process, some mortgage basics, how do lenders, how does lender ensure that you are qualified to borrow. We're also going to have some other topics we're going to bring up as well. We're going to talk about the market cycle because that's something that a lot of people do not talk about, and there's something going on right now that you should know about. There's the market cycle and some strategies for success. Knowing that is that I would like to ask something right now before we get going. How many people here already are in the process of buying a home? How many people, or you can raise your hand if you're in the process of buying a home or thinking about it in the next 6 months? Okay, nobody? Okay, one person, good. How many people have already gone through the process of buying a home? And, okay, great. So we have both ends of the spectrum, and I've got everybody else is in between, which is good because we hope that we can give some value to you and everybody else in here. So as a brief overview, we have renting versus owning, and which is right for you. At this point, I always tell people there's no right or wrong question, right or wrong answer for that. This changes when what I say your why changes. And when your why is going to be why you want to be a renter and become an owner, that's when that's going to change. Because right now, a lot of people are renting and they're fine with it. A lot of people own a home and they're fine with it. But that transition comes with a different mindset of why you're going to transition. So there are different advantages and disadvantages of renting. Real briefly, the advantages of renting is flexibility. You can move when you want to the end of the lease. It's a lower upfront cost. You only have a security deposit and rent to come into a rental. And you don't have to worry about maintenance or repairs if you have a good landlord, I would say. So sometimes that may not be the case. Advantages and disadvantages of ownership. The advantage is that you build equity and have stability. You actually have a permanent home for the time, a permanent address for the time being. You build an equity, hopefully. Number two, you get to personalize it and customize, renovate this home where you can't really with a rental because you lose security deposit, quite frankly. You also have some tax benefits, mortgage interest, property taxes are deductible. Your disadvantages is a higher upfront cost when you buy because you have down payment, you have closing costs, you have additional costs, I always say, and I'll go through that a little later. You are now the owner, and now you have all the maintenance and repairs are on you as an owner to deal with, which is something you always want to calculate for. The third thing is that you, as an owner, and some people do this, and I tell people not to be so caught up in your home values as much like the stock market. Your prices will fluctuate. They'll go up and down as an owner. Some people are very closely tied to that. I always tell people if you're going to be somewhere for a few years or 10 years, it's not best to really focus too much on that. So I wanted to go over that real quickly, and we go over are you ready to buy? So I wanted to ask a question as pertains to the last thing about prices fluctuating. And over the last 30 years, does anybody know how many times we've had a notable decline in house prices? Does anybody have an idea? Over the last 30 years, how many times we had a notable decline? You're right. Both of you are right. Just 2 times. So that shows you the trend is always upward. 2 times was early 90s and 2008 financial crisis. Now, one other crisis happened that's not a blip. The pandemic we just came through. Actually, prices wanted to start to go up, where I was fooled too. I thought like, this is going to be a great opportunity. It didn't happen. Things changed. So just knowing that it's one of those cycles that when people say, house price is going to go down, we've had 2 notable things and both recovered from that over 30 years. So it's still a very good investment. So are you ready to buy? This is the first part. Why do you want to be a homeowner? And this is one of the most important parts of shifting your mindset. And I tell people, your why has to be a why that you can define. It's crucial you have a why. Because if you don't have a why, you're not going to be able to get through the rigors of dealing with talking to Donna, whereas you have to open up yourself to start to the process of your finances. You're going to find ways to talk yourself out of homeownership. And if you don't have that why strongly defined, that's going to be where you're going to have to find your way of, is this for stability? If it's for wealth building, is this for creating a legacy and leaving to someone else, or for anything else like that? Those are very important things to start. How long do you plan on living in the area? This is a really good one to take note of, because I've seen it all. I've seen people tell me they're going to be here for 1 year, 7 years later, we're finding them a home. There's some people, and I tell them rule of thumb, really 5 years is a good time. But typically, most people that are going to be somewhere 3 years and their career path as an employer in that area, you're going to be here longer than 3 years. It's just sometimes we have a smaller time frame in our mind of how long we're going to be here, and the years go by pretty quickly. So you don't want to be putting a smaller window on yourself when you're actually going to be here a little longer than you think. Another thing is look at home prices in the area. So for me, I like looking at home prices. If I go somewhere new to eat or meet some friends somewhere, and I see some properties that look interesting, I'll go on my phone and look to see what the average prices are. These are good things to do, because sometimes you're in an area that's outside the area you started looking in, and you like some of the things you see around there. You should familiarize yourself with what the average prices are. And that will come later why you want to do that. This is another important part: get your finances in order. Now, here's where I tell people that there are two types of health, I say. You have your physical health, but you also have your financial health. Most of us only work on financial health after we have to work on it. This is where I say this is the part now that you start to be a better steward of what you're doing with your finances. Learn your spending habits. Start to create better saving habits. Work on knocking out debt. Learn how you operate, because it's going to help you operate in a better capacity, and also be more responsible, because financial health can impact your physical health. And I've seen it impact people's physical health. Sometimes it's not the opposite way around, but if you have bad financial health, chances are you look like it. You're more stressed, you have more issues going on, you're more agitated. And this is why I say, for your own benefit, you need to start working on your financial health and stay working on your financial health. Just like you do a checkup every year with the doctor. Prepare for additional costs. So this is one thing that some people don't talk about when you're buying. You have down payment, you have closing costs, but you also have other costs like inspections. You have your hazard insurance. You have these things that come up because you need to have that money in line to go. They call POCs, paid outside of closing. So you have your home inspection, your termite. Home inspection average is about $600. You have your termite, that's $50. You have your appraisal, which the lender orders. That's about $600. This market we're in now, there are more what is called contingencies that apply to inspections, which are ways for you to get in to get out of a contract. You definitely want to pay attention to those things, and I tell people never to waive them, which is a home inspection. It's the best investment you're ever going to make for a property. $600 is telling you everything about something that's six figures. And so when you look at that ratio, it's a no-brainer why you should always have a home inspection. It also can get you out of danger, because most times, the average time somebody's in the house where they submit an offer is maybe 20 minutes. A home inspection is going to be here for a couple of hours. Home inspection is going to go in the crawl space. Home inspection is going to check electrical, pull the panel off to see it. They're going to go on the roof. I'm not going on the roof for you. I'm not going to go in the crawl space. So these are things that you get that professional, and you get a report, and now you're able to move forward. So I'm going through some of the earlier parts a little faster, because I want to really concentrate on what we're dealing with now, which we all know. 2025 has been, if anything, the best way to put it. The one consistent thing has been changing daily, right? So we all know that there's been things that we don't know what are happening. We wake up every day, maybe something else going on. And this is why I implore to you guys, everybody in here, when you're focusing on real estate, you need to really learn to ignore the noise. You have to be focused, like you are focused here as you're getting through this time, as you separate the noise to get you past the hurdles to get to the goal. There are other noises out there that will do the same thing if you allow them to infiltrate and dominate your thinking. So why you need a real estate agent? I would say is that you need somebody with expertise to help you navigate a complex transaction. We're the real estate agent. What we're responsible for is writing of a legal contract with addendums, which can be 30 plus pages, dealing with your lender, making certain that the lender has the paperwork together, finding the correct terms, because the contract is time of the essence, depending on when you start it. Addendums can be really contingencies. You need that person to then follow up with time constraints for your contingencies, contact and handle logistics with the title company, further negotiation for when things don't actually go as well as planned in the beginning. You also need somebody who knows the business and can negotiate on your behalf to get you the best deal. Just because a property is listed at a certain price does not mean that you need to offer that price. I'm certain everybody knows somebody who has sold or heard the story of somebody whose house is worth $100,000 more than anybody on the block because that's their house. And they have the right to feel that way. But my job is to make certain telling you they may feel that way, but really this is what their value is. And you shouldn't offer anything higher than that. Because you don't want to put yourself at a disadvantage of overpaying for something when it's not there. Now, you do have contingencies, and that's part of our job too. We set things to help you pull yourself out the deep end, as I say. Your home inspection is one thing to pull you away from the deep end. If there's things that come up that we have no idea about, to walk away from that deal. Your appraisal is a way that the lender also ensures that they're not in the deep end with you when you offer, when you put an offer in of something that's much higher than what the value is. And so those are reasons why you want a real estate agent to help you, is expertise, legal advice, writing it up, explaining it to you in layman's terms of how this is going to operate. You need somebody who also is going to be, and this is why I try to tell people that I know I'm not for everyone. Every agent's not for everyone, but you need to find the agent that's compatible with you. You want somebody who's going to be honest with you. One thing about my clients, they always tell me, Oren, you're brutally honest. I'm always going to give you bad news first and then bring you good the news after that. I need you to digest when things don't go well. I don't hide bad news from people because then it turns to an infection, I always call it. I have to give you all the good news first and something bad later. It just negates everything I told you. That's good. You want somebody who's knowledgeable. You want somebody who actually, depending on what your outlook is where you're first starting to buy, you may be trying to sell. You may be trying to buy something where you're looking at a house tax situation. You want somebody who actually has experience in doing that. So that helps you because when you get to stumbling blocks or the issues that you don't know about, that agent can help you because they've done that. My history, I've done flips. I bought my home a while ago, 1999, and I'm an investor. So the things are, the one thing I tell people is first, a lot of people talk about rates, interest rates are high. When I bought, my interest rate was 8.25%. 8.25%. Then that was a low interest rate. Interest rates, one thing about interest rates I was told that I've seen over my time, the lower they get, the higher the prices go, if you haven't noticed the correlation. When they get higher, prices stabilize and start to flatten a little bit. So with that type of thinking, you want to also remember that if people are waiting, I had some clients say they're waiting for the market or the interest rates to go down. I've told them, you're waiting for prices to go up. Because if you wait for it to get to 4, guess what's going to happen? If you only qualify for 350, you're getting blown out the water because not everybody can afford past that number because the price of money has changed and gotten cheaper. You also have more competition. You're also going to have people waiving everything to beat you. So I say that to also say that be careful of the noise because sometimes you may listen and say this is a bad time to buy, but actually you have to know when it works for you. And if you're able to, you need to start to apply that now, because if not, you're going to be in competition with a lot of folks who are going to go harder than you, which sometimes is okay for them. But I don't suggest that you do certain things that waive your protections. And that way you're leaving yourself vulnerable. And there are plenty of stories of people during 2001 to 2004 that waived everything and found out later that some of their choices were not the best. So I don't want that to be anybody here. Anybody buying, I always tell them you need to get a home inspection. You don't know what you don't know. So you need that person to be there to help you. So choosing the right home. So these are a couple of pillars I always say. You look at location, size, and amenities. The second thing is you want to look at how to choose between wants and needs and the importance of staying within budget. So location, size, and amenities. So when I talk to clients, I tell them we have to start with a pin. And that pin is what you need to be in close proximity to, whether that's your job, whether that's a school, whether that's your house of worship, whether it's a metro. We have to start with something and then create a radius around it. So we start with that pin and we go, and then I can know your commute time you're comfortable with. If it's 15 to 45 minutes, whatever it may be, that's how we can start to create a grid of where exactly works for you and not all over the place, because right now we have limited inventory. That's been happening since the pandemic. And that's because a lot of people, as we call them, golden mortgages, they are not looking to sell. They got under 4%. And they're rigid, which has affected the market as far as supply. But that's what it is. So you need to be really strategic and really start to narrow down what you're looking for, because it's going to help you. The next thing is choose between wants and needs. And I put this here because this is typically what clients tell me, what I want, what I need. I say reverse that. I need to know what you need, and what you want, I hope to get for you. Example, if you need 2 bedrooms, but you want a gourmet kitchen and you want hardwood floors, it does no good for me to find you a gourmet kitchen or hardwood floors in 1 bedroom. Your needs are non-negotiable. I need to know the needs. You need to know your needs, really. Another thing is you need to know that be realistic. You don't need to come, if you've been living in a 1 bedroom, per se, right? And you're looking for the first start to buying a home. Your first home does not have to be your last home. You need to look at a stepping stone effect. You buy something that's compatible for what you can afford. Later on, you sell that. You move up, and you do the same thing and repeat the process. So if you're in a 1 bedroom and you only can afford a 1 or 2 bedroom, why would you afford a 3 bedroom? Unless you have somebody who's going to be renting that part too. We don't need to go that high, because we want to keep your numbers as comfortable as possible, which goes to importance of staying within budget. And Donna's going to come. She's going to talk about everything about mortgages and give you a short overview. What I tell clients is that a lot of times, if you got your financial health in order, you may qualify for a lot of money. Doesn't mean you can do it. You want to find out and tell her, when you qualify, this is what I'm comfortable paying per month. Because that's where the line came in of house rich, cash poor. You can, if you qualify for $500,000, well, all you can really pay is a mortgage based on $350. Why are we looking at anything above $350? We need to bring that down. We need to make certain that you are going to enjoy the home, and they don't see you and you really are suffering in your home. You don't want to have that happen to you. So those are important points that you want to make certain that you are aware of, because a lot of times we are triggered to overspend. And I get it, because this is what the consumer-minded media does to us. We trigger to spend. We trigger when we go different places to buy. But when you're dealing with a home that's 30 years, you really need to be as pragmatic as possible, because those things are going to come back and haunt you. So these are steps of just the home buying process. The first thing, you have to get pre-approved. Without being pre-approved, you're just looking at things and you have no idea what you can afford. So it goes back to what I said before. You want to make sure you can afford that. Once you're pre-approved, we look around, we look for a home, you make an offer. If your offer is accepted, it's called a ratified contract. We schedule inspections. Home, termite. We review the inspection report after the inspections is done. What that does is if there's some things that come up, we may have to do further negotiation. The appraisal comes after that. We order that. Again, if it hits the number or the price, we're fine. If there's something that's different, that's lower than what you're offering, further negotiation is needed. During that time, after those things are done, you want to get your homeowner's insurance. We call it hazard insurance. They're the same thing, just so you know. And you're going to be following up the lender for any last-minute documentation that's needed. Closing day, we do what's called a final walkthrough before you go to closing. What's that? We go and check the house to make certain nothing's missing, nothing's damaged, Because once you sign, everything you sign for is yours, right? So I've done many closings. I've had 3 examples of why a final walkthrough is so important. One, somebody took the refrigerator from the house when we went to close. We found that out and got a credit. One, there was a broken window. Some kids threw a rock through the window. No fault of anybody else. The third one was really drastic. We saw the person trying to take out appliances through the walkthrough. And I said, "What are you doing?" "Oh, well, we didn't think you wanted appliances." "No, that was part of the price." Oh, you're familiar with that?
In my case,
Yeah.
they took out all the piping,
Mm.
pipes from the basement,
Mm-hmm.
so it delayed closing by a month.
Yeah.
Plus,
So,
they wanted temporary.
mm-hmm. So that's the reason why. I'm glad you brought that example up, because if you don't do that and you just went to closing and signed, that's your problem. You can't go for recourse at that point because you signed. And good luck finding somebody that's going to be willing to offset that once they already have the funds that have been wired and sent to you. So after that, we go to signing at the title company, and congratulations, now you're a new homeowner. This is the process. Steps may take a little bit more, take a couple more entailed details when you have the further negotiation. If an offer is not accepted, these steps may repeat themselves, but these steps are going to be pretty much the same for the process. So these are things to know, and I'm glad you brought that situation up that happened to you, because unfortunately, some people this is where you have to look at the credibility, the expertise of who you're dealing with. Everybody's not of the same cloth in any particular fashion, any field you're in. Some people are good. Some people are very good at their craft. Some people have expertise behind them. Some people are just starting out. We all start from somewhere, so we always want to keep that in mind. But sometimes you have to really evaluate who you choose to partner with to represent you. Because if they're not representing you properly, you only can imagine what's going to happen on the other side when there's something that has to be negotiated. So you want to make certain that it's one of those things that you are aware of. My tips are definitely for this market, you want to be a little bit more aware of being more open, I should say. And like I said, the one constant thing going on now is nothing stays the same. The same thing I tell clients, you have to start to be comfortable being uncomfortable. If there's an area in that grid or that radius that you've never seen before, but it fits everything else, you need to explore it. Especially if the price point works, especially if the amenities are there. A lot of times, and I had a recent, and I'm getting ready to wrap this first part up soon, but I had one client that recently we just settled on about a month ago. They were really in Petworth. Now, I live in Petworth. They really wanted Petworth, Northwest DC. They really wanted to be in Petworth. We looked around, the price in Petworth for here. I said, have you ever considered Riggs Park, which is right over here? For those not familiar with it, it's right over by the Fort Totten Red Line Metro. There's a new Aldi there. There's a Walmart there. The library's been redone. They had no idea. They just never went there. They ride bikes. It's a 10-minute bike ride from where we were looking. We went over there. They loved it. They ended up finding a home. They've closed on it. So the idea of they were open to looking, it had everything they wanted. They just never went there. And so I say that to say that there are times when you're looking, when you start that process, and you have it locked in your head that you have to be in a certain area. And I say to you, remove that if you can. Because importantly, you want to make certain that you are fulfilling the needs. The needs are the major thing. Because if the area you like doesn't have the needs, you're not going to be able to get in there. So I say that to say, these are things that we want to make certain we import to you. And I want to get ready to turn this over to Donna. And here's a short video that pretty much captures somebody else saying some of the same things. So I'm hoping it's going to work. Well,
Just give that to me separately. I'll send it out after the workshop.
Everybody, can you hear me okay? Yep, all the way in the back. I'll try to speak clearly. All right, next slide here. Mortgage basics. First of all, I'd like to welcome everyone, and it's a real pleasure to be here to help you guys understand what we do day in and day out. And I am the money lady, so I have a lot of friends, and they come looking many times for a little help. And Orrin had mentioned I did graduate from the University of Maryland, and then I have actually been doing this a little longer than 20 years. In fact, when I graduated, Boomer Esiason was the quarterback of the football team, and a young Len Bias was a freshman, and interest rates were 17%. And as soon as I graduated, I studied business, finance, econ. I got into the mortgage business, and rates were 17%. But it didn't take long for those rates to come down. And I guess within about 4 or 5 years, rates were down into the single digits. And all we kept doing all day long was just answering the phones. Everybody wanted to refinance the rate that they had on their mortgage that was at 12, 15%. And we were offering loans at that time about 9%, which was great back then. So as Orrin mentioned, there's always these cycles with home prices, interest rates. We did see the lowest rates hit during COVID. Never thought I'd see rates below 3%, but there are a lot of people out there with a mortgage below 3%, and they don't want to move. They want to sit tight. So what is a mortgage? Well, it's a big fat loan. You guys may have some student loans I've seen can rival the size of a mortgage. You have 30 years to pay it back. We can also offer you a 25, a 15, 10-year term to pay back that mortgage. Those are fixed rates, typically. We also have adjustable rate mortgages. They are not that popular, but just to give you a quick rundown on those, they have more risk. They may start at a lower rate. So for instance, today, a 30-year fixed mortgage is at 6.5%. The adjustable rate you might be able to get at 6%. Now it'll be at 6% for 5 or 7 years. And then if you still have that loan, that rate can adjust, and there are caps, and it could go up as high as 5% above that initial 6%. So adjustable rate mortgages can be great for someone who knows that they may not be in the property that long, and they don't have to worry about what's going to happen in year 7. And then, of course, you can always refinance out of that as well to get a new mortgage if you're still staying in the home. Okay. So what do lenders look at to make sure that you are qualified? We need to look at your income history. Typically, we need a 2-year work history. College graduate, that is part of the 2 years. So if you are to graduate, get a job paying a salary, and you are on that job about 3 months, you can qualify for a mortgage based on that job. So we would verify your school history with a transcript or a diploma, and then we would verify your job with a couple pay stubs. So that can happen. We're also going to look at your credit history. So we're going to look at credit scores. We're also going to look at your debt. We're going to look at your assets available to purchase a home. A debt to income ratio, we use gross income for qualifying. So if you make $5,000 a month and have very little debt, and that's gross, then we will take 45% of that 5,000 up to almost up to 50% in some cases, And that's how much of a mortgage payment you qualify for. So if your gross is $5,000 a month and your mortgage payment's coming in at $2,200, you might be fine. You can qualify for a payment up to that level. Of course, it's important that you're comfortable with whatever payment, and you're doing your budgeting so you know that you can afford that. Because we can sometimes tell people, oh, you can go up to a $3,500 payment, and they're like, oh, no, I can't do that. So, you have to figure out what's comfortable for you. Importance of credit scores. How many here have credit? Show of hands. Great. So most of you have been through that process. You've applied for credit. If you have student loans, obviously you had to get credit for that. And the higher your credit scores, the better options you have when it comes to financing. You have many more doors that will open up for lower rate loans, cheaper costs associated with those loans. So the importance of credit scores it's a big factor. And you guys are all quite young, I imagine, and you're building that credit. So once you have that credit, you want to do all the right things. Pay your bills on time. Don't overextend yourself. They do say that the ideal credit report contains a mortgage, a car loan, and 2 credit cards. That's definitely not written in stone because lots of people don't have that scenario and they still have great credit. Folks that have credit for a long period of time have pretty good credit too, because the length of time factors into the scoring. So building and maintaining good credit will really open up more doors for you in the mortgage world there. Okay. Down payment strategies. So we have traditional savings. We will take your money for that. And there are quite a few down payment assistance programs for first-time buyers. And in fact, 35% of all buyers last year were first-time buyers in the country. So you guys are in a big group of people right there. The counties, the states where you're going to buy may have special programs to help you with down payment and closing costs. There are a few in the state of Maryland. Montgomery County has a few, up to $25,000 you can get to help with down payment and closing costs. Gift funds are an acceptable source. Gift funds can come from family, not cousins. They ruled that one out. So, because everybody has a cousin. So family to include siblings, parents, grandparents, in-laws, aunts, uncles, children. Employer can give a gift. We accept that. And a close personal friend. So you have to kind of establish that relationship. It could be somebody that you've roomed with for 3 years, and maybe you're going to move into a house together, and you can kind of develop that and prepare that information for us. So that's acceptable. I had one recently where a gift was given to a fellow worshiper at church, and they had a long-standing relationship attending the same church, and we accepted that. 401k loans, once you get those established, you can borrow against a 401k if the program allows that. And you can also withdraw from your 401k plan and not be penalized, but you will be taxed. So those are acceptable sources of funds for down payment. And a lot of the first-time buyer programs will only require 3 to 3.5% down payment. And then if you can negotiate a seller to pay your closing costs or a part of it, then you really may not need a whole lot of money saved up in order to buy your first home. What makes up a mortgage payment? Principal and interest. And I think I had a little example here. So if you were to borrow $300,000 today at 6.5%, principal and interest would be $1,896. That's a 30-year term. So you pay that for 30 years. Real estate taxes and insurance. That's the property tax, and that's the home insurance that's required on every home purchase. Real estate taxes, if let's say they're $315, $325 a month. Insurance $75 a month, and private mortgage insurance we'll talk about. That would give you a total payment of $23.96. Total payment to borrow $300,000 today at 6.5%. Private mortgage insurance is an extra cost associated with the loan if you are not putting down 20% or more. So that is an insurance to protect the lender in case you default on the loan. So you have to pay that. It goes away after a period of time, typically 10 years, that can go away. And there's different things we can do with the mortgage insurance in the loan. We can either finance it or do a monthly, include it monthly in your payment. Lots of loan options out there. The most popular one these days is a conventional loan. You can do as little as 3% down. The FHA loan is a little more lenient on credit, so lower credit scores may not fit into a conventional. So we could put you in an FHA loan, 3.5% down payment minimum. VA loans are for veterans or active duty military, so you have to meet that criteria. Those are great loans. They're zero down for the most part. USDA loans are also zero down, and that is through the agricultural department. They're rural properties. So when you're working with someone, like for instance in Montgomery County, Poolsville is about the only place in Montgomery County that has rural housing loans available. But Frederick, Carroll County, some of the southern counties, you can find areas that will accept USDA loans. I will say your credit has to be pretty good for those. A jumbo loan in this area is over $1 million. So if you're going to buy something and borrow $1 million, we have a little bit of slightly different guidelines for jumbo loans. Okay. This is a program that's offered by the state of Maryland, the Smart Buy. There are flyers on the back table about this program. They've kind of reduced the amount that they'll lend over the years, so it's down to $20,000. So basically, if you have student loan debt that adds up to no more than $20,000, this program will eliminate that debt for you. Now, if you have $25,000 student loan debt, you're going to have to, if you want to use the program, come up with the $5,000 to get it down to $20,000. And then the rest of the $20,000 can be wiped off. And they basically give a loan for 5 years. It's forgivable. So you got to stay in the home 5 years. And then after 5 years, that $20,000 loan that was given to you with no payment, no interest to pay off your student loans is totally forgiven. Okay. It used to be up to $40,000, so I think that would be applicable to more people these days. But it's something to think about if you're getting those down. You had a quick question?
Private or just
Public. This is state program.
if you have private,
Either one.
either one, okay.
Yeah. You just have to get all of them paid. So we pull a credit report, any student loans show up on there have to be covered by the $20,000. Yeah. Now, if you're two people buying a home together and you both have student loans, we only have to worry about one person getting rid of their student loans. If the other person still has them, they can't take advantage of the program, but together they would still be eligible for this, for the one person that they're going to wipe out their student loan debt. Okay, so we have some flyers back there. And I just want to mention again, we have these QR codes on your table. If you want to scan those, you do have to enter your phone number and email. We will not call you, but we'd like to share market updates periodically via email. We won't we won't barrage you with emails, but I think you'd find them very helpful bits of information. So we'd appreciate if you would register on there. And was there anything? So we're going to go through one more section. I'm almost done with mine. Okay. And then we'll take questions at the end. So I'm going to go one more slide here. For any of you that leave Maryland and move to another state or go back home, if it's one of those yellow states, you can call me. I can help you with a loan. Orrin can give us some advice, but a referral to a realtor in any of those states. So that's where we are. And we'll take questions at the end. We also are doing a raffle. We have about 11 gift cards to give away this afternoon. Okay. And I'll hand it over to Orrin. Thank you for your time. I think he has a couple more things. How are we doing on time?
1:21. So just a few minutes.
I think he's just cut a couple quick slides.
Yeah. So we're gonna probably want to close with this. We have talked about earlier the market cycle. So I really think this is important. Other than that, I'm certain Deborah will be able to share the rest of the presentation with you because we wanted to make a little bit more personal with what's going on now. So one thing I wanted to make sure that I talked about is market cycles. So these two represent real estate market cycle. This represents your real estate cycle of emotions. These are very key because this is a typical market cycle, but we also have to account for, we have something called undersupply that's been applied to this cycle because we have not had a typical inventory of real estate. Again, we've heard people with golden mortgages are not selling. We have those different things happening that are not typical, but this is what we have in a typical cycle. So with what's going on with undersupply, where we're at right now, we're pretty much right around this area. We have gone from lower sales. We've seen the construction starting to fall. We'll start to see that a little bit more now with some of the additional costs of building. Prices, they're not really falling, they're stabilizing. Because I think what's going on now, sellers are more realistic in saying that we know it's not going to be multiple offers in a few days, where it was going to take a little longer. Buyers are more realistic. We're not going to see 3 or 4% mortgages again. So you both have a mesh of both parties understanding that the market has changed, and we're starting to see the rising yields. Undersupply is still because of low inventory, and what we're starting to see now, as Donna said, is falling interest rates. So from what we have now, we're pretty much between these two, in my opinion, between 8 and 9. And if we go over here to the cycle of emotions, we came from euphoria not too many years ago. And now we're in more of a panic depression type of mode. What you see, like I said before, the noise. You see a lot of this in the media. You see, oh, this is the worst time. These are things you have to look against the grain. This is when you have the best buying opportunity. You have less competition. You have more negotiation can happen. When everybody is on the way up and euphoria is high and buyers are strong, you have less negotiating power, because if you don't want it, you'll be moved out of the way by somebody who wants it more. So these are two things I just want to let you guys look at, and you'll be able to save this, because this is when you start to look at your opportunity. It's times like this you'll be able to equity build a lot faster. So we want to open up to any questions you might have. Thank you, everybody, for being here. We really appreciate it. Hoping that we can give you some more value. You can follow up with us and let us know if there's these things will be on the slide that you can take with you. I just want to open up to anybody to make certain that we have time to answer any few questions before we do a giveaway. Thank you.
Hi, thank you for your presentations. I'm curious about why someone would choose to take on a 30-year versus a 15-year loan.
Well, the 30-year is a much lower payment. Now, a 15-year is a great loan program. The rate's a little bit lower if you can afford that payment, because you can definitely pay a lot more principal with each payment. But the difference in payment could be hundreds of dollars. So a lot of people aren't comfortable starting out with that. But it's a great program if you can afford it, you're comfortable.
What would, I don't know if the name is, typically if someone were to take on 30 versus 15, what would the difference be in interest rates? Is that-
Well, it's around 1/4%. So that's all. Like a 15-year is about 1/4% lower in rate.
So 6, 7, or 6, 7, 5 or something?
It's like 6.5 on a 30-year, 6 1/4 on a 15-year.
Okay,
Today.
so it's mostly what you can pay monthly.
Yeah, which you're comfortable with. Now you can take a 30-year and shorten the term by paying extra. So pay a 13th payment or an extra $100 or $200 every month with your payment, and your loan will just end. Might be year 20, year 17, it's done. So that's a good practice if you can stick to it.
Okay,
Yep.
thank you.
Question in the back?
Just following on the question, I've heard that there's like tax benefits for like young families with children, for example, like when they buy a house, they get some like tax benefits. Like how does that interact with like a 15-year versus 30-year loan? How makes sense? It's like
Well, that might work on your tax returns. If there's no real benefit from a mortgage lending standpoint, other than maybe you would qualify for some closing cost assistance. The more people you have, yeah.
So it sounds like if I can afford a 15-year mortgage, I should go with it. Is that I understand that.
If you're looking at the big picture, what am I saving on interest over 15 years? It's a lot more, and you'll build your equity faster, but it's not right for everybody. I can hear you. Go ahead.
Is there an age limit on the 30-year loan? For example, would you give this 30-year loan to someone who's in their 40s and who might retire?
If they're 80, yeah, it's not, we can't discriminate on age. So even if, and I have a refinance right now, someone is 80 years old and they're refinancing to a 30-year mortgage. Question? Oh,
Out of curiosity, well, two questions actually. First, what's the typical rate for an agent? For a rate that has to pay to an agent?
oh, to an agent, your
Typical
commission.
rate. Well, commissions are negotiable. So typically we're seeing anywhere between 2 to 3%. They're all negotiable.
Okay. And the other question for those of us who, other parts of society, we like to buy a plot of land and build on it instead of buying a home. Do you have any suggestions or tips of what to expect to have to protect it regarding that?
Well, good. You go
Well, I
ahead.
was going to say there is financing to build a home. So we offer that. So if you buy a lot, and typically to buy a piece of land, you have to put down 20% and get a lot loan. And then you can get a construction loan to build the home.
Okay, and can one get an agent to navigate?
Yep. Mm-hmm.
You can, but you want to make certain if you're buying land, you need to check your zoning. If you're looking on a source online, make certain the zoning works. And you're going to do what's called a perk test to make certain you can build on that land. Some land is not buildable, so you want to make certain, especially if it's a great price, is a reason. You want to make certain that you have somebody that can tell you what's going on, and you have to find a good builder. Not all builders are the same, especially with land. There's been many cases where some people have been left high and dry. So you want to make certain you have those things in order.
And your realtor can help you navigate that process too.
And we have time for one more question. Can you two stay a little bit later if people
Yeah,
still have
that's fine,
questions?
sure.
I just want to make sure we have time while you're all still here to do the raffle.
Yeah.
And so thank you for your patience. So last question here.
Yes, I'll make it quick. On that note, what are your thoughts on buying new versus not so new? I've heard a couple horror stories about people buying new homes and then they're left with a lot of additional costs that they didn't know about, like maybe it's a new development, so you're paying for like the funding of the whole development or something in your cost of the house. So what are your thoughts on that?
It depends on the builder. This is what really that people do need to understand. You definitely need to have a home inspection. There's two of them. One is called pre-concealment and the other is called an inspection. Most times, and I've dealt with a lot of builders, there are always more, 9 times out of 10, there are more list of items on a home inspection from a new build than a resale house. Period. Because it's a lot of moving parts. There's a lot of different people. And so you should always have somebody representing you for the new build because they're not going to push you to get a home inspection. They're going to show it's new. There's nothing to worry about. And you do have to worry about those things. Pre-concealment is when it's studs, when it's framing. The last one I've dealt with, there were things that were crooked. There were things that were not done up to code. But if they put drywall on top of it, you're not going to know. So every one of them, you want to make certain that you want to look at the community, what's the build out for it, what the amenities are. All those things are being accomplished. So both are good, but you don't want to just think that because it's new, everything is great. Everything you want to make sure you do your research. All right.
Questions?
Yeah, great questions.
Please join me in thanking Warren and Diane.
Thank you.
It's so comprehensive, and I hope you all feel more prepared to buy your first home. There's this home buyer's guide on the back table. I just took a look at it. Please stop back there. This is a great guide. It repeats a lot of things that were said today, but it's nice to have something in writing. So I just have a couple of thank yous. I want to thank my partner in crimes from Grad Student Life, TJ Coplasher and Abisha. Okay, anyways, thank you so much for co-sponsoring. Next week's workshop, I just have to put in a plug for this because one of the things that's so important when you're thinking about buying a house is getting your credit in order. Next week's workshop is about understanding your credit, how to read your credit report, how to build your credit, all things credit. So I hope you'll be able to attend that workshop. And so without further ado, let's do the raffle, right? All right.
It sounds like you're all ready for some free stuff.
How many?
We have 11.
You have 11.
Okay.
11 winners coming.
All right. So, in full transparency, everyone have a ticket? All right, here we go. Y'all see, it's clear on purpose. There's no favorites, okay? All right. So the first one is 485-657. 485-657.
You might have to hand
Okay. Okay. All right. We only gonna read it twice, so after the twice, we're gonna pull another number. Okay, so here we go. 485-620. 485-620. Better winner. Hey! See, I got the lucky hand.